All right. Welcome, everyone. My name is Gershon Margolis. I am the founder of Imperial Advisory. We are a fractional CFO and consulting firm. We work with business owners who need a CFO but don't need a full-time CFO, as well as CFOs who are wonderful CFOs but still need help, whether it's bandwidth or anything else. We pick up where accounting leaves off, and we help business owners and CFOs and really whoever we work for, sometimes investors, working with a bunch of investors now. We help people make better, more informed business decisions. One of the things that we often get involved in is mergers and acquisitions. So we'll be working for a client, and the client is looking to grow. So you can grow with marketing, you can grow with an acquisition. So the client is looking to make an acquisition. There's lots of different reasons, and we've discussed this on other webinars, lots of different reasons why a client might make an acquisition. So you can be buying a customer list, you might be buying revenue, contracts, relationships, one key executive, or you might be buying the staff. I'm actually familiar with a company that's in the process of being bought out, and they're about to have a revolt from like 80% of their staff who are non-shareholders, didn't get a say, and are really mad. And the current ownership is actually sitting at the table with all these non-owner employees, trying to make sure that they don't all walk out the door, because if they do, there goes a lot of the value of that particular company. Anyway, sometimes when you have a company and you're buying another company and you're blending those two companies together, sometimes you're buying the company, like we said, for the people, and you're blending those companies together. What happens when you have different benefit plans, whether it's insurance, 401k, or any of a host of other benefits? What happens if the target has better benefits? Do they lose the better benefits? Do you get better benefits to the existing employees now that you have the new employees? Anyway, these questions and hopefully lots of other interesting things will be addressed in today's webinar. We're very pleased to have Adam Brier, who's been in the insurance space for a long time, currently building up the insurance practice at CBiz, and a very fine person. Always a pleasure to speak with him, interact with him, and I'm so glad to have him here today.
Well,
Adam,
thank you, Gershon, for that warm introduction, and the credit to the Imperial Advisory team for continually doing wonderful work. Great reputation that you guys have, that not only that I've seen firsthand, but also have heard within CBiz. So credit to you guys. Adam Brier. I'm with CBiz here in the New York metropolitan area. For those may not be familiar with CBiz, we're a publicly traded national consulting firm that there's not much we cannot do when we're dealing with an organization, whether it's for-profit or nonprofit. We can make an impact up and down various aspects of a balance sheet. But this area, in terms of the merger and acquisition world of companies buying and selling and consolidating, you're seeing a lot of consolidation in the marketplace, obviously within the financial services industry, manufacturing, distribution, healthcare. Obviously, there's challenges that go in place when you're talking about, you mentioned, culture, employees revolting, different benefit plans, whether or not the private equity firm is involved or not involved. Sometimes they just write a check and they leave it up to the founders to kind of figure it out without any guidance. Then you have other private equity firms that say, hey, listen, we have an advisory team that's in place. We can guide you in terms of making better decisions. They may have relationships in place like outside advisory firms, benefits consulting firms, to kind of help them in the due diligence or pre-due diligence before they buy our company or even post. We happen to be fortunate with our benefits consulting firm. We do a tremendous amount of private equity work nationally in every phase of the aspect. And we get involved in quite a number of due diligence where they bring us in to look at numbers of factors to make sure that the acquiring company, what plans they have, merging it together, what it looks like from a compliance perspective. There's a lot of moving parts. So a lot of moving parts. It's a great conversation, especially with the market environment, the credit crunch we're in, and all that stuff. So it'd be interesting to see what's happening going next year with with the credit environment. So thank you.
Sure.
So one of the things that Gershon, that's talked about quite often are, like what are potential concerns for a chief financial officer, a founder around health insurance plans during a merger and acquisition? Would that be something you want me to kind of go over a little bit?
Sure.
Yeah, I mean, a couple things. So we go through a process where upwards to about a checklist of about 20 different things. We would, a couple areas that we would look at, first and foremost, when a merger and acquisition is taking place, the chief financial officer, founder, or private equity firm needs to, carefully consider different aspects of the health insurance plan, really to ensure a small transition to minimize potential risk. And some of the areas that we look at, I'll name, 3 or 4 is, plan compatibility. You want to ensure that the health insurance plans are both for both the acquiring and the target companies, they're compatible. So some challenges you may have. So if you're a company in New York, but you're acquiring a company in New Jersey or California, there's different, depending on the size of the company, things are different. In New York, if you have 1 employee up to 99 employees, it's community rated. So if you have employees that are 25 years old or 75-year-old, and you're in fully insured group, the plan rates are issued by the in the marketplace. Other areas of the country, they're age banded. So when you talk about plan compatibility, you want to see what's going on in one aspect of the company and the current aspect, and you want to make sure that there's no drop off. We would typically look at comparing plan designs, coverage options, provider networks. We would get a ton of census data regarding employee contributions, really to identify really disparities that need to be addressed. And then you look at cost implications. You look at, the merging required of a company can lead to changes in the overall cost structure, which I'm sure you guys see that quite often. The chief financial officers, founders, they really need to address how combining these plans will impact the premiums, deductibles, out-of-pocket expense. Then you look at the compliance aspect where one organization, they may be doing a contribution strategy based on either, I would say, executive compensation. They may break it out in different classifications. So we would then also bring in our due diligence team to evaluate that, because what they're doing, company A, company B, could be different, and you want to make sure there's no issues. So I'll pause there for any questions or feedback.
What happens when there are incompatibilities, right? You have one company, like what I brought up in the intro. You have a target company that has great benefits, right? They cover all the insurance. They cover everything, right? Same state, same band. I don't know. Let's say they're 2 companies, one that has 150 employees, one that has 400 employees, right? So the 400 is buying the 150. The 150 has amazing benefits. Everything is covered, right? And the 400 one, they do the high deductible plans. They don't provide an FSA. They don't do any of that stuff. What happens now?
Well, I mean, the reality is when you combine different benefit packages, obviously there's complexity involved. The key aspect is really doing due diligence, is getting all the plan designs, getting the structure in place, looking at doing a look back at maybe 2 to 3 years what they were doing, and then really putting together strategy going forward. The challenge is you're not going to really be able to make everybody happy, but you got to look at a couple things. I think one of the things that we do is we do benchmarking. So we'll take a client on, and we'll take their plan designs. we have a benchmarking where we can, look at locally, regionally, and nationally over a broad scope, and we could really compare and contrast what their current plans are versus different peer groups across the country. Um, and you can kind of get it close, but I think the biggest key, Gershon, is communication, is having a buy-in from the C-suite, the HR directors, that nothing's going to be easy. We're going to roll this out in a way that we're going to be educated to the employees. Having good communication, especially when you're rolling out, even if it's, hey, you merge everything over, but things aren't going to take place until 6 months later. One of our strengths is a communication, from a communications perspective, is putting together a multi-sensory approach where obviously you're having live webinars, you're putting together interactive flipbook guides, right? You put together perhaps AI-based benefits enrollment technology for guided activation to educate employees of what their current plans are, what their new plans are, what the difference is of the cost could be, positive or negatively, and then follow up. And what you do in year one when companies combined is definitely not the same in year two, whether it's a merger or not. But I think it's really communication process and having buy-ins across the top that, this is what we're doing now. Talk about where you plan to be year two, year three. Because the last thing you want is have a revolt. Companies are paying X based on obviously the revenue and cash flow of a company, but also one of the biggest values of a corporation is the employees, what they bring to the table. You don't want to have a 30% churn ratio. You're losing your upper management or your key executives. That could be a financial impact that could be huge depending on what industry it is.
Do you see a difference in churn across the companies you deal with based on the quality of their benefits?
You see not really quality of benefits. I mean, listen, at the end of the day, no one's really happy. We had a consultation the other day with a very sizable law firm client here in New York, and large professional services firms, they typically are a little bit older in age. You have partners have been hanging around, late 50s, early 60s. Health issues start to take place. So as much as rich as their benefits are, they're thinking about, some of the partners are starting to get angry that, hey, claims are going up, people are having surgeries, cancer setting in. We have a large population of women and people are having babies. So you can never really make anyone particular happy. It's just really, I would say, listen, it comes down to communication, but really you have a chief financial officer, an HR director, the CEO or executive director. Having them on the same page with the same vision is critical, which is not always the same side. Sometimes we've had meetings with a group where the CFO, they're concerned with obviously operational costs, cash flow. HR director is saying, hey, our employees are complaining. We have a 20, 30, 40% churn rate in the, from a turnover. We need to do something differently. You see more turnover in manufacturing distribution organizations and in the nonprofit. Obviously, hospitality, you could see anywhere from a 20 to 50% churn in those industries. Even with really strong HR, executive directors, and leaders, just because them moving to nonprofit on one side of the street to the other because they're paying an extra $1 an hour could be the difference.
Interesting.
What are you seeing from your side when you guys are coming? Are you finding that organizations, do you see organizations in the space you work in where they're doing pre-due diligence when they're acquiring a company and they're looking at their benefits plans? Are they looking at doing an audit on their workers' comp to see workers' classification codes? That's an area that's sometimes overlooked as well. We did that where we were involved with a manufacturing distribution company here in New York with about 200-300 employees. They were acquiring another company, I believe, down in North Carolina. We went in and we did a workers' comp audit of their properties and everything, and we saw there was misclassifications, and we marketed them differently, and we ended up saving them, I don't know, somewhere around $200,000, not because we did anything really different, to credit to the founders that they allowed us to come in, do a quote unquote a forensic audit of their long-term broker, who has a wonderful reputation. But sometimes people, get lazy or sleep at the wheel. What have you seen? What's your feedback been?
Let me chime in. I would say that
Yeah.
I think workers' comp is a very good idea. It's nothing we normally didn't do in pre-acquisition, but the benefits are very tricky. I think you've got to make sure that you line the benefits up. And usually whoever has a better benefits win, because you can't buy a company and they have Cadillac benefits and your employees don't. One thing we always realize in acquisition, people talk. They talk about their salary, they talk about their benefits. So they talk to their coworkers, especially on the side, how much they're paying you, what kind of benefits you get. So you really got to make sure that you plan that out ahead. So one group doesn't have better than the other ones, because the one that does not, sure going to complain and say, how come these guys get better benefits than me?
Yep. And then,
Same thing
what
with the
happens.
salaries too. Salaries
Yeah.
are in the same boat.
Yeah. You see that all the time. I mean, especially obviously in, the white collar world. So, doing that benchmarking early on is important. And having the right people at the table, to the best you can.
Hey, Adam, it's Buddy. Do you have a minute? Can I ask a question?
Please.
So I've been involved in a lot of M&A stuff, especially the last couple of years. But I think that more importantly, even just having day-to-day changes in benefits is complicated. Are you guys finding that people are even less happy today than they were 10 years ago with no matter what's going on? Because I think that's sort of an overriding feeling that I get, is that this is just miserable, no matter what you do.
People are unhappy. I mean, listen, what was it? CNBC came out, statistics that, the average person to really live comfortably, the country, need to make $80,000 a year. The cost of living has gotten astronomical. So you look at the health insurance costs have risen, tremendously over the last 5-10 years. You have workers' comp rates have gone up. Let's just say you're an individual that, hey, you make a $150,000 salary, but you've been the same for the last 5, 6, 7, 10 years. FICA has gone up. So you're taking home less. So people are unhappy. So what you're starting to see with chief financial officers and HR directors is, to their credit, they are starting to look at alternative strategies to drive down operational costs. We all know that, there's a very small percentage that really impact claims every year. So while all of us pay health insurance, the reality is that, it's few and far between where we're going to have something catastrophic. I'm 52 years old. I think catastrophic wise, the last catastrophic thing that I had was 10 years ago. I ruptured my Achilles, right? So, not many people are going to have operational costs. So what people are looking at is alternative strategies. What are some of those alternative strategies? One, PEOs, or professional employee organizations. We're a big believer as a firm that a PEO has a good place in the marketplace, whether you're small, medium, or large. We include it as part of our due diligence. You look at organizations that are over 100 employees, starting to look at alternative strategies such as self-insured plans. Gershon, you raised your hand, or
No,
you're stretching?
no.
Self-insured. So these are ways where you can drive down operational costs for the employer, drive down the cost per month to an employee. And then the other thing is the rise of high deductible plans, or HSAs, where you could put money away pre-tax. To me, is a wonderful thing, because it allows people to really fund themselves. It's triple tax free. I've been contributing to a health savings account for my family for probably 8 to 10 years. So I think the older generation of HR and CFO, they're starting to be open-minded to alternative ways, so they can level the playing field, so people can come home with more money. And I'll say this, buddy, would you rather, for organizations that, hey, a 3% raise really isn't cutting it anymore, depending where you are, would you rather have a 3% raise, or would you rather have the ability where if I'm an employee, I could take home, my net income can go up by you making an increased contribution to my health insurance? So that's the way people need to start thinking a little bit differently. And not all HR CFOs look at it. I've been in meetings where sometimes the chief financial, they're stuck in the ways, and the HR department is pounding at their chest that, hey, listen, we're losing people. We need to start thinking differently. So it's a challenge, but to the credit to the community and the advisors out there, they're starting to do things differently.
I would say that across the board of my clients, which are probably 6 to 8 that I spend time with every week, 75 to 80% of them have picked on health insurance and the cost of processing payroll as two things that they want cuts in.
Yeah.
That's too expensive. I want you to find me $30,000 or something. Just, they make up crazy numbers to talk about that. That seems to be a trend, is that this is an area that people just feel like they should target.
Yeah, I would agree. I mean, from a payroll perspective, I mean, the large payroll companies, everybody's pricing around payroll, especially, if you're, between that, 50 and 1,000 employee mark, all the pricing is about the same. There's definitely wiggle room. What I often see is CFOs and HR directors get involved with human capital management systems and look to add on performance management, applicant tracking, data analytics, churn. And while all looks beautiful, all these analytics, they're paying an extra 10, 20, 30% more than they typically would if we're just having basic payroll, and they never really use it. So they don't use it, or, at all. And in regards on the benefits, I mean, that's why, like, PEOs, when it makes sense, it works. The challenge with the professional employee organization is that you get underwritten based on age, sex, and industry. You can submit your census. They underwrite you. Year 2, you're underwritten differently because now they're looking at your claims. So year 1, or even 2 years in, you may have a flat or a slight increase. And then next thing you know, you have large claims that come in, they're either going to bang you out or increase you on your per employee per month costs or operational costs, or they're going to increase the health insurance side. And then you have to either switch to a different PEO or look to go in the open market. So every year is a little bit different. The only thing that I would say to organizations, as long as whether you've been with your benefits advisor or retirement consultant for a while, it makes sense, I think, every 3 years to bring in an outside party in to do due diligence. If they uncover hard and soft dollar profit leaks and your advisor's been sleeping at the wheel, you have a business decision to make. So that's what we try to do with organizations.
We have a couple of questions here from Dan Falco. Shout out to the between 5 and 10 people watching us on LinkedIn as well. So question, do you see any correlation between a lack of proactive health strategies and workers' comp claims?
I don't have the data and analytics on that, Dan, but I know I've seen studies through SHRM and other organizations that when you have a healthier workforce, a more engaged workforce, they're leveraging communications in a lot of different ways. They're having quarterly meetings. There's a reduction in workers' comp claims. There's a lot of new tools and software solutions out there that once someone does get hurt, getting people to get back to work faster has been out there as well. So there's a lot of tools and resources out there. But I don't have the data in terms of, what that correlation could be. But, healthier workforce, I'll take it, for instance, is that, listen, as we're all lazy by nature, right? Some of us have gone through our annual checkups. We've gone to the doctor, we've gotten our eyes checked, we've gone to the dentist. I will share with you personally that my wife runs around running her own business. That if it wasn't for my organization putting together wellness strategies and incentive strategies, that if I don't, as a family, between myself, my wife, don't take care of the basics and they validate it, she has white coat syndrome. She wouldn't go to the doctor. By going to the doctor earlier to prevent diabetes, glaucoma, whatever it may be, going back to what Dan said, you get unhealthy, you get hurt. Next thing you know, you have a workers' comp claim, and that could be catastrophic on the organization. So that's a great question, Dan.
Do you notice a difference between different industries in terms of what they look for when they're doing due diligence on an upcoming transaction? Like, is manufacturing companies, do manufacturing companies care more about things than service companies or than retail? Or
I will say that you see often in manufacturing distribution companies that for the most part, they are trying to get away with the lowest cost plan possible. That industry, manufacturing and distribution, wholesale, where you have a lot of warehouse workers, right? They're paying minimum wage, at or near minimum wage. A lot of those employees are seasonality. So they may go from working summer job, which could be landscaping, working outdoors, and in the wintertime they go back in the warehouse. So you see that with whether it's in the nutraceutical industry, clothing industry, people come and go. Some of them opt out where they don't want insurance whatsoever because they don't want to have any cost. So you see that a lot in that particular industry where, they are, whatever the bare minimum is. I've been across some organizations where they were completely out of compliance, and they're out of compliance until they get a knock on the door and they'll pay the fine. ACA came out, how many years ago already? There's still organizations that are, above 50 employees that are skating on in compliance. If they have different, organizations or different, you see that all the time. That's an industry, and it's probably because the nature of the margins of that business. Have you guys had conversations with clients who are like, where any trends have you seen as well on that side of the business?
Defer to Steve and or Ken.
Ken's on mute.
Oh, I'm on you too. I'm sorry. Can you repeat the question again?
Oh yeah. So my question was, hey, I see more in the manufacturing and distribution space, obviously hospitality, where you see more of an emphasis on, let me put the lowest, cost plan in place, regardless of the benefit of the employee and the coverage. And you see more waivers in M&D, manufacturing, distribution, hospitality, than obviously in, the technology space, nonprofit space, stuff like that. I just want to see if you guys have come across stuff like that.
I've seen more of the high deductible plans, and where the company realizes that we can give a high deductible and we can reimburse some of the employees and still be cheaper for us, because especially if you have a young workforce. If you have a young workforce, they're not going to the doctor.
No.
So you could just high deductible, and then you could, pay the first amount from a pool, and it's a win-win for everybody.
Yeah, you implement an HRA strategy,
exactly.
where you're basically self-insuring yourself. And obviously sometimes in the manufacturing distribution, so you really, the young employees, they opt out. They'd rather have that money in their pocket.
Right.
If something happens, they'll just go to the doctor.
And I know Jeff Wiener's on this call, and he does a good job designing plans for clients where he will not even change the carrier, but redesign plans with deductibles and could save the,
Oh yeah,
client lots of money.
yeah. Jeff, I know, and Jeff, Jeff is one of the more respected advisors here in the region, and he's a big believer of high deductible plans, HSA plans. Big believer. I'd rather, it's like you'd rather keep on you'd rather hold your money before, don't give as much money to the government as you can. Hold on to your money before giving it to other people. So, Jeff, anything you want to add in, because you've been doing this a long time and you're well respected. Jeff's on mute. There he is.
Deductibles, if you have groups if you have a group of 2 to 100 in New York, you should be on a high deductible plan, because the difference in premium between a traditional copay plan and a high deductible plan is so big, there's no risk, because you're going to save more in premium than you're going to pay out in claims.
Yep. And we rarely go to the doctor.
Yeah.
Even for me, I'm 52, and I think, Jeff, you're 52 and a half as of now. When do we really go to the doctor? Knock on wood, unless hopefully I don't get hurt playing pickleball this year.
Well, Aaron Rodgers just went to the doctor. He had what you had.
Has it been? Yeah. Is it official?
It's
Torn Achilles?
confirmed. Yeah, he's done for the
God.
season.
Yeah, I did that 10 years ago, actually on Labor Day, playing tennis. So it's horrible. It's horrible, but onward and upward.
So, Adam, we've been talking a lot about health insurance. Are there any other types of benefits that you bump into when you have two companies merging? There are other benefits, places where sticking points, things that people like to look at when we're looking at a transaction.
Sure. Sometimes you come across organizations that just have health benefits, but they don't have the ancillary insurance in. They don't have the proper life, long-term disability. Maybe they're not taking advantage of what the carriers are offering from wellness initiatives, or getting discounts on pharmacy. Putting health insurance involved. The cost of RX costs have gone through the roof, depending where your age and what you need. The specialty drugs that are coming in the market are making a big impact on the rise of health insurance costs. One of the areas that we look at when you're talking about the merger acquisition or working with a private equity firm is doing also due diligence on the retirement or the pension plan. I can't tell you how many times where we've gone in, done an independent benchmarking of their 401k plan, and they've worked with a local advisor who's more than knowledgeable, but because they don't write a lot of plans, the fees that they're being charged from the record keeper, like an Empower, a Voya, or Principal, just across the board, they may be paying 15, 20, 30% higher in advisory fees, because they're not getting access to institutional class shares. So we just did an audit on a nonprofit client. I don't know, it was like $5-6 million. They're working with one of the larger advisory firms. They're using a different record keeper, and we probably saved them nearly 20. I think it was 22% off fees, just because they had like 20% of their plan sitting in a money market account, and the fees they were being charged on the money market account, which you make no money, was
Right.
exorbitant. So, once again, you have great advisors. If you're working with an advisor a long time, great. You don't know what you don't know, bring in an outside benefits consultant, a 401k advisor, a workers' risk consultant. Do an executive compensation overview. Big area that we've been just exploding in nationally is we do executive compensation review. We'll come in and, whether it's for-profit or nonprofit, we'll do benchmarking of what you're paying out your employees, and it's eye-opening. We were at a nonprofit, the firm, CBIZ Marks Panel was doing a nonprofit symposium last year, and one of the deputy directors of a very large nonprofit said, listen, we just engaged in executive compensation with one of our parts of our firm, it was eye-opening that there was a big disparity of what we're paying people. So that's important. So there's so many different factors that you should be looking at. And you would know this better than I that, hey, if you come in, you do due diligence and you're able to know ahead of time that you could drive down operational expenses on a benefits plan by 15-20%. You now uncover an extra 5-10% on the workers' comp. You then uncover additional hard and soft dollar profit leaks on the retirement or the human capital management. Depending on the industry, you find an extra $200,000-300,000. What difference could that make in a multiple? Depending what's
Right.
so. There's a lot of private equity firms that don't even do that. They'll just, hey, this is what the average multiple is, but depending on what side of the seat you're on, why not do it? There's no reason not to do it.
Well, bringing up an interesting point, and it ties into a conversation Ken and I had with a client yesterday. How much of what you could do should you be factoring into the cost or into the transaction itself? And what I mean by that is we have a client who's claiming, we have a client who's the potential buyer, the seller of a large but for-profit company, which is losing money at the time, so it should be for-profit company, is basically saying, well, we could do X, we can do Y. We've uncovered things where the buyer is looking at it and saying, we could do Z or A or B. How much of that should the buyer be paying for? It should go into these conversations. And how much of that should they say, listen, it's not here now. This is an opportunity. We'll take advantage of that if and when we buy it, but not putting it into the analysis and the conversation today.
That is an excellent question that it would be wrong for me to provide expert advice in, because that's an area where I would say our private equity due diligence teams or the corporate attorneys kind of work out. So that's an area that, I guess every case is different. I guess when you are sitting at the table and you're looking at things, it goes back to do due diligence ahead of the time. If you know you're going to be in negotiations requiring the company, just do the due diligence. Having more information and sharing that information that, hey, you know what, we're going to acquire you, and then 6 months later, by not, I would say, bastardizing the plans, we're going to drive down operational costs by X. We're going to, your turnover is, 30%. We're going to put strategies in place through employee engagement, wellness strategies that have proven that could reduce turnover by an extra 5%. Let the really smart people figure out what that impact could be, whether you're on the buy side or the sell side. I'm not that intelligent on that side, so it wouldn't be fair to me to say. I have the good fortune of leveraging a lot of people within my firm, that are far smarter than I, just like within your relationships that you have within your firm.
Well, I think you're smart. I appreciate you joining us, and but thank you. It's always good if you feel that you're not the right person to answer a question that you direct it. But we have other people on the call. Steve and Ken, do either of you have any thoughts on that? If there is an opportunity to cut workers' comp costs or cut healthcare costs, should the buyer be rolling that in to kind of a pro forma, or do they say, well, we haven't recognized those savings, that's gravy, that we'll recognize, we'll take advantage of that later?
Well, if you're the buyer, you're going to say, I'm not paying you for that savings. That's some of the synergies I get. So I'm not paying if I'm able to cut your workers' comp down. Now, if I'm the seller, I'm going to say, I've identified these synergies and I want to get paid for them. So, it depends on what side of the fence you're on is the position you're going to take. And somewhere you'll have to meet in the middle.
Exactly.
Got
Someone's got to make the decision on both sides. Someone's got to eat a little bit of each part, I think.
In the case we were dealing with yesterday, it was something that the seller had not identified. The buyer identified it, and well, certain things the seller did identify, but certain things the buyer identified, the seller had not. So that
Well, if I
was,
was the buyer and I identify these, I'm not sharing them with the seller. I'm not telling
Right.
them, I could cut your cost by, I'm not bringing Jeff in to show you how I can cut your cost by 100 grand, and then I paid for it. The part of my diligence, I'm looking for synergies, and I'm not sharing them with the seller. I'm saying, listen, we've got these synergies. Once we buy, let's pro forma this out. Our EBITDA, we're going to grow. That's why I'm buying it, because I want to get synergy. So I don't know why you would share with the buyer synergies you find. I really don't know
with
why.
the seller.
Why you share with the seller synergies that you found once you do the deal. It doesn't make any sense.
And one area that
Yes.
I didn't really touch upon. I think it's important is bring in a legal team. Like for us, when we do we're brought in, we'll also include our ERISA attorneys that we have, our compliance people, to look at their employee handbook, look at workers' comp claims. If you're in New York, the rules and regulations in New York are a lot different than California. So, doing that type of due diligence of, hey, you know what type of claims are out there from a workers' comp, right? Because they could stay in the books. How long, what's that? You have a claim that happened 6 months ago, depending how large it is and how long it's pending out, you can go from a 1.0 mod to a 1.25, and that could drive up, depending on your payroll or your industry, especially manufacturing distribution. You could have a $500,000 claim. It can take you to a 1.2 times a $20 million payroll. That's big money. So looking at that, what maybe has transpired behind you, workers' comp claims, any type of EPLI claims. One, do they have a proper EPLI insurance policy in? I see more often, especially groups, smaller organizations under 50 employees, probably don't even have an EPLI policy in place. So that's a good question. Do you have one in place? If not, I would get one in place. I think it's important. PEOs usually put that in place, but I always recommend getting an umbrella policy on top of it, because PEOs usually put EPLI policies in place to kind of protect them, not so much the other side. So those are two areas that I think are important to look at as well, is compliance and any back claims that you do have, because what's the implications on that? All right.
Got it. Thank you. So we have a note here from Lisa. Lately, I also see lots of companies using high deductible health plans, but not funding the deductible. If the EE employee is looking to save, that type of plan hurts the employer, I guess.
Right.
Is looking to save, that type of plan hurts the employee when they go to the doctor. That's just a high deductible EPO for the first dollar copay for the era. I don't know what any of this means. PCP,
for primary care, RX. Listen, at the end of the day, there's different strategies depending on the organization. What you do for a professional services firm will be completely different for a manufacturing distribution company, for a nonprofit. I think the first thing, number one is benchmarking. Doing a benchmarking locally, regionally, and nationally in your vertical to see where you compare and contrast against your peers. I think that's priority number one. And then also, at least what we try to do is, how often does the benefits broker and the accountant sit down with the founders? So I think having more seats at the table, so everybody's working collectively together, can only be helpful, right? Because what I see on my side on the benefits, workers' comp, retirement side, you gentlemen may not see on your side, not because you lack the intelligence. Maybe we ask more different questions or uncover different areas than you. Like very often, we ask an organization, hey, what's your turnover rate? How are you measuring that? Are you seeing that more at, how are you seeing the turnover? Is it locally, regionally, nationally? Which area of the department? Maybe they're putting the wrong people in place, to be leaders. So, okay, maybe it's not the organization, benefits are strong. Maybe you just don't have a training program in place for your managers to coach, train, and mentor. So there's a lot of different things. So I'm a big believer of collaboration. Some people are not, because they're afraid that someone's going to take their business. I think if you bring good value to your clients and your outside centers of influence, good things will happen. I have a question for you guys. So, going into next year, you obviously interest rates continue going up. What sort of trends, what are some of the fears your clients are seeing with the higher interest rate market? What are they concerned about? What were, 2 or 3 things that they're most concerned about going into next year where, obviously, the trend is not your friend right now. So what are you seeing as we approach, obviously the top of the hour?
I'll share feedback from one client. We have one client that I've been working with that has an outstanding loan. I believe it's a term loan, not a line of credit, but either way, whatever it is indexed to the market. So their rate has been going up and up and up, and they're seriously considering giving the money back. Now they don't need it right now, but we're encouraging them not to necessarily do that, because even though it is, we're not completely done with this, but what we're sharing with them is, depending on what their growth plans are, having access to that capital, they can still get a 5% spread, right? So let's say it's costing them 10%, they can put in a CD, 12-month CD or whatever for 5%. Having the money, like, who knows if they're going to get the loan when they need the loan. So the amount of money that they're going to lose, I think it's a $1 or $2 million facility. It's the type of thing where that's a small investment to make sure that if anything goes wrong, or if there's the growth that we believe that they're looking at, that they're going to have access to the money they need. Because the last thing we want is for them to save, a few $1,000s and lose $1 million of sales because they can't handle the payroll or whatever. They're in a business that's very payroll intensive, long lag until they get paid. So meaning they're looking at the interest rates, they're seeing that expansion in the spread between what they borrow at, what they're paying, and it's pushing them to make decisions which they might not be the best for them. And again, we're working with them. Part of the question is, where are they planning to go? Where's the business going to go? Are they going to need that money? If they're going to need the money in the next year, they're better off keeping it now than going through the whole process again.
Yep. Have you seen success with like ERT, with clients getting money back from the ERTC, where for some it's been a long process?
We've seen clients looking into that. I would say for the most part, the accountants are dealing with it. We've got clients whose accountants say that they're not eligible, and the clients disagree with the accountants. It's kind of a sore topic for me. But I don't know if Steve or Ken, do you have anything to add on the interest rates or the ERTC?
Most of my clients have gotten the ERTC, and I know there's a lot being written about people applying from some of these, not so above board companies that, there's a company that just, their name is ERTC Credit. So they just started just to, so you got to be careful, because the government's going to come after anybody, you may get the money now, but then they're going to come after you if you weren't eligible. So my clients have gotten, because they've legitimately gotten, the ones that have applied for it. So I would say, if you're eligible, apply. You could still apply. In terms of interest rates, that's affecting one of my clients doing an acquisition. He's had to bring down the value of what he's willing to pay because of, the cost of money. So it's, compressing values, but that's what's going to happen.
Let me add one thing to what Steve was saying. There's a fellow I know who works basically helps people find acquisitions. And what he told me a few months ago that he was seeing is, he was seeing essentially what Steve described, where the amount that someone's willing to pay goes down, but when the sellers don't want to go down, they're getting much more creative with the structure. And so you might leave the sticker price the same, but let half of it be a payout over a period of time, where the seller's financing it, sometimes even perhaps without charging any interest. So it's effectively a lower rate, but sometimes you can keep the same sticker price up top. Ken, you have anything?
And some of the clients, concerned with the rates as far as borrowing last year and earlier last year, and now paying higher interest rates on that compared to what they used it to buy or used it to fund their cash flow. But some of them are using their ERC credit to take out some of their debt. So I also have clients that weren't eligible for the ERC credit because they made more revenue and coming out of COVID than they did prior to COVID. So
Thank you. All right. Anyone else? Any final questions or thoughts before we wind down?
Nope. I think,
Oh,
listen, at the end of the day, my message is do due diligence, kick the tires. Even if you have a long-term advisor, second set of eyes, can't hurt anybody. And, and you gentlemen know better than anybody that a difference of, finding, a couple 100,000 or $1 million plus, that could be realized very quickly by making some changes, what that impact could be on the buy or sell side. So that's my 6 cents.
got it. Well, sounds good. Thank you, Adam. Thank you to all the people who joined us here, most of which are gone. We still have a few people on LinkedIn. So thank you all for joining us. And if you need to reach out to Adam, how's the best way to reach out to you?
You can feel free to hit me up on LinkedIn, or my email address is adam.brier@cbiz.com. cbiz.com. I'll put my information in the link, or feel free to hit me up on LinkedIn. This is a time where a lot of companies are evaluating because you're approaching year end or you're forward planning for 2024. For whether it's health insurance or just understanding the market environment they're in. So I thank you, everybody.
All right. And if anyone needs to reach us, you know where to find us probably. Otherwise, Gershon@imperialgrp.com, or Brittany, who the invite came from, or you can find us on LinkedIn as well. Thank you all. Have an amazing day.
Thank you, everybody. Have a beautiful holiday
you.
coming about.